Welcome back. In our last session, we explored DCF analysis, how to value a company by projecting its future cash flows and discounting them to present value. But what if I told you we could flip that entire process around? Instead of guessing what a company might be worth, we can work backwards from its current stock price to discover exactly what the market thinks will happen. This is called reverse DCF, and it's like being a financial detective. Think of it this way. Every stock price tells a story. When Apple trades at a certain price, that number isn't random. It reflects the collective beliefs of millions of investors about Apple's future. But what exactly do they believe? Will Apple grow revenue by 5% annually, 15%, 25%? Reverse DCF helps us decode these hidden expectations. Here's how reverse DCF works in simple terms. Instead of starting with growth assumptions and calculating a fair value, we start with today's stock price and ask, what growth rate would justify this price? We're essentially reverse engineering the market's homework. Let's walk through a practical example. Imagine TechCorp trades at $100 per share. Using reverse DCF, we might discover that this price assumes TechCorp will grow its cash flows by 20% annually for the next 5 years. Now we can ask the critical question, is 20% annual growth realistic for this company? This is where reverse DCF becomes incredibly powerful for investment decisions. If you believe TechCorp can only grow at 10% annually, the stock looks overvalued. But if you think 30% growth is achievable, you might have found a bargain. The reverse DCF doesn't make the investment decision for you. It clarifies what decision you're actually making. Let's examine why this matters for real investors. Traditional financial metrics like PE ratios tell us how expensive a stock looks relative to current earnings, but they don't reveal future expectations. A stock with a PE of 25 might seem expensive, but if the market expects explosive growth, that price could be justified. Reverse DCF uncovers these growth expectations explicitly. The beauty of reverse DCF lies in its simplicity for everyday investors. You don't need complex Excel models or finance degrees. Many online calculators can perform the math. Your job is interpreting the results and deciding whether the implied expectations make sense. Consider 3 scenarios when using reverse DCF. First, the implied growth rate seems reasonable. This suggests fair valuation. Second, the implied growth looks impossibly high, potential overvaluation. Third, the implied growth seems conservative given your research, possible undervaluation. Let's look at real-world applications. During the dot-com bubble, reverse DCF on many internet stocks revealed growth assumptions of 50% or more annually for decades. These numbers should have raised red flags. Conversely, during market crashes, reverse DCF often shows negative growth assumptions, sometimes creating opportunities. Reverse DCF works particularly well for established companies with predictable business models. It's less reliable for startups, companies undergoing major transitions, or businesses in rapidly changing industries. The technique assumes some level of stability in the underlying business. Here's a practical framework for using reverse DCF. Start by running the analysis on a stock you're considering. Note the implied growth rate. Then research the company's historical growth, industry trends, and competitive position. Ask yourself, does the implied growth rate align with your research? If there's a significant mismatch, investigate further. Common mistakes include taking reverse DCF results as gospel truth. Remember, these are implied expectations based on current prices, which can be influenced by sentiment, momentum, and irrational behavior. The analysis provides insight, not absolute answers. Another pitfall is ignoring the discount rate used in calculations. Different rates produce different implied growth assumptions. Reverse DCF also helps you understand your own investment psychology. If you consistently find that your growth expectations exceed market assumptions, you might be naturally optimistic. If the opposite is true, you might lean pessimistic. This self-awareness improves decision-making. The technique becomes especially valuable during earnings seasons. For portfolio management, reverse DCF helps ensure diversification, not just by sector or geography, but by growth expectations. You might discover that all your holdings require similarly aggressive growth assumptions, concentrating risk in ways traditional analysis might miss. As we wrap up, remember that reverse DCF is a tool for better decision-making, not a crystal ball. It transforms vague feelings about whether stocks are expensive or cheap into specific, testable assumptions about future performance. This clarity leads to more confident investing decisions. In our next session, we'll explore comparable company analysis, how to value businesses by looking at similar companies in the market. You'll learn to identify truly comparable companies and avoid common valuation traps. Until then, try running reverse DCF analysis on a few stocks in your portfolio. You might be surprised by what the market really expects.